Hey everybody, this is Tim Hart with VanDyk Mortgage here in Fort Myers, Florida. Pretty pumped to bring you a series we're going to be doing about the importance of credit scores, how to improve them, how to maintain them, and what they're all about. And so I brought in a little bit of an expert. Sometimes you guys may not trust me, but I brought in the expert here. I have with me Pamela Paulson from Home Loans Assistance. Pamela, how you doing?
I'm doing fantastic. How are you, Tim? Thank you so much for having me.
Oh, yeah, no problem. Thanks for joining me. I appreciate it. We already, just full disclosure, when we have deals that we can't do due to credit scores, Pamela and her company is who we consult with, is who we refer them over to help them improve their score. There's things that we can do, Pamela, on our end, that just through experience or other programs to help them improve their credit score. But at the same time, sometimes they're a little too far gone and they need professional help like you guys. And that's where you come into play for us. So we appreciate you.
Thank you. Well, I appreciate you guys. Anything we can do to help the consumer get to their desired credit score so you can close their loan. So essentially what Home Loans Assist, what my company does is we work on the consumer's behalf to correct and delete erroneous and information and errors falsely reporting on the consumer's credit report. Most consumers don't realize the staggering number of errors on the credit report that oftentimes go unnoticed. And these errors detrimentally affect a person's credit score, which ultimately could cost them hundreds of thousands of dollars over time.
So you're just talking like basic errors, like calling something revolving when it's an installment, or like
it's a wide range. It's how things are being reported, if they're out of the statute of limitations. It's coding errors. People often can get merged. Their information can get merged onto other people's credit reports. It's a wide gamut of things that we see.
Okay. And that's where you guys have the time and energy and experience to be able to do these type of things compared to the normal consumer that's full-time job, family, everything else going on. I mean, it's a major, major task to, fix anything to do with your credit as well.
It is. And what consumers don't realize, there's a big difference between just disputing a trade line or an account, which we find consumers will go to the, online sites and just start disputing information. What we do is we submit a verification investigation on behalf of the consumer to go after and attack companies and the credit bureaus to ensure that things are being reported correctly.
Cool. So you and I are going to be doing a lot of these videos coming up, and I want people to understand, before we get into all these topics we're going to discuss, why. Like, why should they care if their credit's good or not? Sometimes you hear people, oh, I don't care anymore, I'm done, blah, blah, whatever. Like, there's a reason why you should have good credit, and I would like you to explain why. Or the benefits of credit. Sorry.
Yes, there are several reasons, several benefits of having a good credit score. First and foremost is the low interest rates on credit cards and loans. So as you know, Tim, the interest rate is the cost of a consumer, what they have to pay for borrowing that money in the first place. And the interest rate is directly tied to the credit score. So if you have a good credit score, you'll almost always qualify for the best interest rate. And you'll pay lower finance charges on credit card balances and loans. Furthermore, the better, having a good credit score, the better chance for credit card and loan approval. With shaky credit, there's always that fear of being turned down, and that's not a good feeling for anybody. Another benefit of having good credit score is negotiating power. A good credit score gives you the leverage to negotiate lower interest rates on credit cards or loans, and also you get approved for higher limits. So banks oftentimes are willing to let the consumer borrow more money when they demonstrate that they actually pay back what they borrowed and they're paying on time. What I'm seeing more and more now too, Tim, and tell me if you see this as well, some consumers who are trying to apply for rental houses or apartments.
Mm-hmm.
Landlords are now using credit scores to screen tenants.
Yep.
A bad score can severely damage a consumer's chances of getting into a rental property. Have you seen that, Tim?
Oh yeah, yeah, absolutely. I hear about that already. Mm-hmm.
Yeah. Oh, it's better car insurance rates. Insurance companies say that people with bad credit tend to file more claims. I don't know if you've heard that, but these people are then penalized with higher insurance premiums. Also, cell phone companies. If a consumer with poor credit tries to purchase a cell phone on contract, usually they have to put down a security deposit or they'll get denied.
Mm-hmm.
And so when that happens, then the consumer, the only other option is to do a pay-as-you-go plan that typically have more expensive plans. Right. And then also with utilities, with good credit, a good credit score, oftentimes consumers can avoid having to put down deposits with some utility companies. So really a good credit score is something to feel good about because, it's getting viewed and looked at across the whole various industries.
Well, yeah. So if you're going to someone to borrow money from them, they want to know, the main thing they want to know is, are you going to pay it back? And are you going to pay it back
Mm-hmm.
on time? And no one can predict, like you and I can't predict in the future, hey, he's going to miss a payment 3 months down the road. All we do is we look at, and that's what credit is for, is we look at the past, not the future, the past. If you paid your bills bad in the past, you more than likely going to pay them bad moving forward in the future. And so that's what we're going to stop today, is get people to get their credit scores improved.
That's right.
So the best place to start is, first off, for this video, what we're going to do is we're going to talk about what it is really. And so the main thing is, let's teach these the consumers out there and the realtors and builders we have, what is the FICO score? And then I would like you to delve into the 3 credit bureaus, Equifax, Experian, and TransUnion, the differences of them, and et cetera. So if you can attack the FICO score first, and let's move on to the credit bureaus after that.
Okay, you got it. So FICO, as we know, is the Fair Isaac Corporation. And essentially, it's a group of mathematicians and statisticians that sit around creating algorithms or scoring models to assess a consumer's creditworthiness or credit risk. Now, there are over 50 algorithms that have been created by FICO over the many years. 8 have been approved by Freddie and Fannie. So just specifically speaking of the mortgage industry, 8 have been approved out of those over 50 algorithms that FICO created by Freddie and Fannie, but only 3 of those algorithms are used for the mortgage industry. Those 3 scoring models to assess a consumer's credit risk are Beacon 5.0, Classical 4, and Fair Isaac version 2. And Beacon 5.0 is tied to Equifax. Classical 4 is tied to TransUnion, and Fair Isaac version 2 is tied to Experian. Basically, all these 3 scores it's a fancy term for 3 scores in one. So when you, in the mortgage industry, Tim, when you pull a report to assess what type of credit score, credit risk, or worthiness a consumer has, you're pulling a tri-merge. Tri meaning 3, and it's the 3 scores into one. So to break it down a little bit more, every consumer has 3 separate credit reports and 3 separate credit scores, essentially 1 report from each of the credit bureaus calculating different factors. So the tri-merge then combines the individual reports, and as a result, you get a full picture of a consumer's credit profile.
Mm-hmm. Yeah, and so like for mortgages, so you'll have a high score, a middle score, and a low score. And almost everything you do in lending is all done on that middle score. And
correct.
So one of the questions I had asked, it was my buddy Rodney Rhymes had asked me, what causes one score, one algorithm to be that much different than another? Like, why would the TransUnion be 740 and Equifax be 650?
That's the million-dollar question. So these algorithms, what's built into these scoring models, they're just assessing different things based on the consumer's payment history, amounts owed, balances, credit card balances, length of credit history. So they're just looking at different factors specific to that consumer.
I got you. And so, but then, for instance, like the mortgage credit I pull today, the three scores, and then they go to another mortgage company right down the road the same day that uses the same scoring systems. Are they going to get a different credit score at that mortgage company than mine?
It should not be different. Now, are we talking shopping window, or are we just specifically speaking a variance in scores?
So initially I was talking about the variance in scores, but he had also brought up that he felt like different mortgage companies pull different credit reports, meaning like I would pull one and they would try to get pre-approved at the other preferred lender as well, and our scores were way off of each other. I didn't see that happening.
So that should not occur. Even if you use to pull credit, if you use let's say Credit Plus to pull your credit, and let's say that consumer leaves your office and goes to a different mortgage company and they use CBC and Novus to pull their credit.
Right.
Those scores, they're still using the same algorithms. It's the same throughout the mortgage industry. So those scores should be identical. There should be no difference. And even pulling on that same day, because you do a hard pull to pull a person's credit in the mortgage industry, even if their score with that inquiry, even if it drops typically 3 to 5 points, it's not going to be reflected that same day.
Oh man, we're going to be covering hard inquiries on a future video. That's a whole nother topic right there. So
yes.
You got anything else you want to add to what we just talked about with those credit bureaus? I think you did a great job on that.
Yeah, well, thank you. No, I am very passionate about teaching and educating about the credit industry. There's so many different moving pieces. I say that I live in a gray world. It's not black and white because it's, always fluctuating and changing depending on what's going on with the different sections with credit. But I'm just thrilled to be able to get some educational tips out there to your viewers.
Oh, cool. I appreciate it. So if they have any, and there's going to be more videos, guys, coming out after this, but if they have any questions, Pamela, what's the best way for them to contact you?
Okay, so they can email me at pamela@homeloansassist.com, okay, or call me. Our company's based out of Colorado, but we're licensed and bonded in every state.
Okay.
Our business has been around since 2005. And so my contact number is 303-746-4655, or reach out to Tim Hart and he'll get you in contact with me.
Yeah, cool. I appreciate it. So I'll put all Pamela's information in the contents of the video there, along with mine. You guys got questions, concerns about credit to try to buy a house? I'll even help you if you want to try to buy a car. If you want to just talk about your credit, I'm here to help you. And then I got Pamela in the background as well to help. So appreciate you guys watching. Make sure you like, share, and subscribe on whatever video you're watching this on so we can stay in touch and be looking for future videos. Thanks, guys. Thanks, Pamela.
Thank you.
Bye.